Hi, good morning, everyone. Thank you for joining us today. We hope wherever you are in the region, around the world, you are well, you are safe. My name's Toby Sylvester. I'm the Partnerships Director for the Middle East and Africa at Global Data, based out of our regional headquarters in Dubai. So at Global Data, we work with banks, financial institutions, and consulting firms across the region, typically supporting teams with strategic insight across market trends, technology disruption, and competitive positioning. If we could have the next slide, please, Stephen. Thanks. So for today's session, we'll be sharing a range of insights from a banking and payments intelligence center. We'll be combining proprietary data, regional analysis, and our analyst perspective. While this slide is up, please feel free to scan the QR code. This session is interactive, so please do use the poll function when prompted, and there will be a Q&A tab at the bottom of your screen for any questions that you would like answered. Any questions that do come in, we will endeavor to answer them at the end of the session. And we plan to answer as many as possible whilst we are live. And of course, we will follow up on anything that we may miss. At the end of the session, you will also receive a copy of the recording and slides as well after. Across the region, we're seeing rapid digital adoption, evolving consumer expectations, and continued investment in areas like AI, cybersecurity, and embedded finance. Alongside this, the geopolitical landscape continues to remain complex and it's increasingly more challenging to navigate. So, the aim of today is to bring together multiple perspectives: macroeconomic context, financial performance, consumer insight, and executive sentiment in order to give a more complete view of where banks are today and where the market is heading. If we can go to the last slide, please, Stephen. Great. So, look, leading today's session today is Stephen Walker. He's a senior analyst at Global Data's banking and payments practice. Um, Ultimately, Stephen has over 15 years of experience analyzing the financial services sector, including previous roles at firms like Gartner and Forrester. At Global Data, he focuses primarily on the strategic intelligence and the impact of this disruptive themes such as AI, embedded finance, and digital banking transformation. So he'll be walking us through the key data sets today and the trends that we're seeing across the region. Steve, over to you.
Great, thanks for that, Toby, and good morning, everyone. Welcome to this webinar. So, as Toby says there, I work primarily on our strategic intelligence products, which looks at the impact of disruptive themes on financial service providers. So, this is our theme map for 2026, so what we see as the 36 most disruptive themes next 12 months out, divided into tech, industry, macro, and ESG themes. You'll all likely be familiar with thematic research as long practiced by equity research departments of investment banks, and we repurpose that methodology here for consumer FS. So the logic being those firms that are blindsided by any of these themes, underinvested or understudied, risk losing market share and declining share price, whereas those firms that are best prepared will gain significant advantage compounding over time. To qualify as a theme, by definition, it has to drive a certain volume and velocity of market activity. And one of the ways we measure or quantify that is through our signals data on our intelligence center. So this is sort of an early warning indicator that looks at things like patent applications in a given thematic area, hiring activity, M&A, corporate filing mentions, executive surveys, and so on. I've got a sample of some of the signals extracts here just for illustrative purposes on this slide. We then run benchmarks on preparedness of banks in each of these thematic areas through our scorecard. So we run these for the top 50 organizations by market cap across each subsector we cover. So that's banking, payments, and wealth management. But we can run them for any bank in the world. To be transparent on the scoring criteria, so we have an automated module that generates the initial score based on the signals data that I just mentioned, but we also overlay that with analyst opinion and a wide variety of other data assets that sit within our intelligence center. So this could include consumer surveys on customer sat with different dimensions of digital experience, spending forecasts in given tech areas, financial and operational data, market shares, and so on. Together, right, that gives you an extremely multi-dimensional sense of bank performance, allowing providers to get a clear line of sight from, say, how underinvestment in a given tech theme can be traced back to declining customer sat in a given area, and in turn, declining market share. At its most powerful, right, these data sets allow banks to see exactly the gaps that exist between themselves and their competitors, and what specific measures can be taken to close those gaps to limit those attrition risks. Now, if you'll forgive me the slight soft sell of our intelligence center there, but that's just to flag the excellent raw ingredients that exist in terms of data sets. But what we're excited to do today in the brief time that we have together is to make the metaphorical cake. So bring together these different ingredients into a synthesized perspective on what are the key trends shaping banking and fintech in 2026, and specifically how they'll play out across the region. So you know what's coming. Here's the five handpicked themes that I want to discuss today. But before we get into that, I think we'd like to do a quick poll, the first of the session. So the question for you all in attendance is, what do you think will be the single most disruptive theme across 2026 in the region? So just as those answers are coming in, bear in mind, IT colleagues, that I can't see the results coming up live, but while they are populating. So I acknowledge this can feel a bit like a dud question, right? Because in the current environment, AI is always the top answer, but maybe interested to see here if some of the more urgent and unexpected themes of what's happening in geopolitics might attract more attention over the next 6 to 9 months. I guess also another reality here, right, is that each of these themes in practice is often really about what does AI mean in those specific areas of digital banking, embedded finance. So the more I think about it, there are a number of limitations with this question, but I'm keen nonetheless to hear the answers. Perhaps if I could invite Toby just to call those out, because I've got an issue on my screen, I can't see them.
Yeah, absolutely. Geopolitics at the moment is really taking the race, followed by AI and fraud. Had we not been in this current scenario, perhaps AI would have been number one. But there you go. Geopolitics is taking the lead.
Yeah, excellent. Thanks, Toby. That's interesting. That was not unexpected. I mean, that can be the nature of the long-term important themes that banks have to respond to, were displaced by the most urgent and rapidly evolving and unexpected. And geopolitics is a great example of that, and also a great example of the value of thematic analysis, so as not to be blindsided by these themes. So I wanted to start with that as the first to discuss today. It'll be no surprise to the audience, there's been particularly voracious client appetite for intelligence in this area based on downloads on our IC. We have published regular updates to the different advisory reports that we publish in this area, because, of course, this is not, in our view, a one-off event, but this is a new normal in which a heightened volume and velocity of change rooted in these geopolitical tensions is rendering traditional modes of strategic and contingency planning less effective, and creating new vulnerabilities for banks. Historically, faced with operational uncertainty, it wasn't unusual for organizations to end at a certain amount of paralysis, so the risk of being underprepared, or to guess early or to guess wrong on a big initiative, given the change. Our overall advice, and it's obviously much easier said than done, right, is to try to turn down the volume on short-term noise as far as possible, and remain focused on those long-standing tech transformation imperatives, but with a rejuvenated sense of purpose, by mapping how those fundamentals are even more important operationally in the current environment. But that's the long-term perspective. But I wanted to make more short-term specific observations on what we see as a result of the ongoing conflict. So first, here is the importance of data center strategies and operational resilience. So on this slide, you're looking at executive survey data from Celent. Celent is now a global data company effective December 2025 from an acquisition. They bring deep tech-specific, sector-specific expertise into the global data family, and they ran this survey at the end of 2025. So what you see here, this is obviously top drivers of IT strategy. The IT security and operational resilience was a top driver globally. But if we break that out by region, on the right here, you see that Middle East Africa is actually much lower scoring. Now, of course, on March the 2nd, the drone strike that led to an outage of the AWS data center in the UAE, leaving several banks in the regions experience outages, consumers, corporates left without access to basic banking. services. And those attacks have highlighted an earthly reality that the cloud infrastructure is not nebulous computing, that cloud runs in and across physical data centers. Now, in Europe, DORA requires financial institutions to spread their operational dependencies across multiple regions and providers, and we expect forward-looking institutions outside of Europe to emulate this approach more closely, with banks reviewing and remapping the various third-party dependencies across major value chains and regularly stress testing systems across a wide variety of different outages of their own tech stack, of third-party platforms and partnerships, and so on. Next key impact we've seen is around diversification. So this is data from Global Data's Wealth Management Industry Analytics. As you see on this slide, geopolitical events are now ranking as a more important driver of asset allocation than purely economic factors. So this means decisions are increasingly shaped by security risks, sanctions, energy supply disruptions, and a global fragmentation rather than just GDP and rate cycles as it would traditionally have been. Traditionally, fixed income provided the first line of defense in periods of stress, with diversification and risk concentrations driving roughly half of high net wealth fixed income allocations. But we've seen the ongoing conflict in the Middle East to change that role. So precious metals has emerged as a clear beneficiary in the current environment. So gold is attracting future safe haven demand as investors seek the protection against inflation and geopolitical uncertainty. We've got here that commodities already stand at 11.1%, with a significant share, as you can see on this slide, in gold and gold-backed ETFs. The last element I wanted to focus on in terms of near-term impact is the impact emanating from the vast expatriate workforce across the region. So as you see on this slide, based on Global Data's remittance analytics database, between 2020 and 2024, remittances from the UAE alone to four countries total 43.3 billion in 2024. So an increase of 11.7 billion, or a CAGR of 8.3% over 4 years. So a massive volume increase. Now, in the immediate aftermath of the crisis, remittance service providers observed a sharp spike in transactions attributed primarily to workers taking a proportionary measure of sending those accumulated savings back home. But we don't expect that, of course, to continue. And depending on how long the conflict continues for, will determine the long-term prospects of the money transfer fintech providers in this space, such as BRAC Bank, Wise, Western Union, and so on. Next theme wanted to look at, not unrelated, right, to geopolitical situation, insofar as those tensions can create new actors, new motivations, and new attack vectors, is fraud and cybersecurity. Now, for market context here, fraud is increasing. I'm sure that is not new information to anyone on this webinar, but just to put some numbers around it. So 18% of the global population, so approximately 1.4 billion people, have experienced fraud in the last 3 years, according to our survey data. That's up from just 10% of the global population last year. Admittedly, there were some definitional changes to the survey, so it's not an entirely apples for apples comparison, but absolutely right, the number is moving in the wrong direction. It's not just the increase in absolute numbers that's worrying, but the global distribution of it. So if we focus here on markets across Africa and Middle East, we find fraud rates are disproportionately higher. You see 25% here for Saudi Arabia, 35% for UAE. And we would expect those rates to continue given the number of factors that we're going to come to. The UAE, of course, has been a particular challenge with the rapid adoption of online mobile services and crypto trading. Those large expat workforces have also been a source of vulnerability, as fraudsters have targeted consumers that are not familiar with local regulations, and of course the high concentration of high net worth individuals. And if you put some numbers on that, right, so this is the vulnerability to fraud by income groups, and you see that high net worth are more vulnerable to multiple types of fraud, and well, basically to all types of fraud, significantly more than mass market or mass affluent, and that's particularly true for money stolen from a customer's account, fraudulent applications, and credit card fraud. we dig a little further into that, so generationally, Gen Z with larger digital footprints, more of their lives online, more likely to be a victim of fraud. We've covered the high net worth because of the perceived size of the prize. But just to develop this point around crypto products, you see that bottom right here, significantly more likely to be victims of fraud. That's part, right, a function of these consumers being more adventurous, so inclined to try new things generally. But it's also the features of crypto, the decentralized nature, the anonymity, which allow for new types of fraud. So it's easier for fraudsters to obscure transaction rails when laundering funds, for example, or setting up scam investment vehicles, which we have seen many examples of. And then lastly, on the bottom left here, there's a slight elevation in risk apparent for those with shared finances. So dual account access creates more entry points for fraudsters. Now, we're going to get into AI separately later, but certainly AI is critical in the fraud context. But actually, in the short term, there's real uncertainty around whether it will do more harm or good for banks. We ran a webinar towards the end of last year on this, and the consensus from panelists was actually, given that fraudsters are unregulated by regulations and ethics and consumer trust issues, that they're likely to adopt the technology more quickly to exploit it more in the short term. But over time, more benefits will accrue to banks. But it will be an ongoing arms race. And in our industry interviews, the most promising near-term applications for banks are the comparative advantages in AI. So traditional fraud prevention is set in preset rules, but as the types of fraud evolve quickly with new types of attack vectors, agentic AI in particular in its adaptive form is most able to become more intelligent and act more autonomously on flagging suspicious transactions, but it also has a key role in working as a co-pilot, so it's helping risk managers work through whether the suspicious transaction is to be cancelled or the transaction should be allowed to go ahead. So there's kind of two initial dimensions on threat intelligence there, but arguably a third one is around the use of generative AI for synthetic data. So a common issue we hear in training algorithms around fraud is that particularly for new types of attack vector of a given data set, perhaps only 2 or 3% of the data is specifically on that type of fraud. But using synthetic data, that they can create 100% data sets that mimic the characteristics of that fraudulent data and allow those algorithms to get much smarter, much more quickly around those fraud types. I want to move now to the digital banking theme. And for context here, so we have been profiling new digital bank business models well in excess of over 400 across the planet now. We'd argue with far more examples of failure than success. But in the last 4 years of these long form reports, we've profiled and categorized what are the standout successes, what are the best business models, what have been what we consider Me-Too entrants, and where have there been evidence of these new entrants delivering carefully calibrated value to local sources of customer pain. Now, before we get into the data we've got to share here, I wanted to do one more poll question. The question to attendees here is: retail banks across the region, do you think they believe the threat from fintechs and challengers has increased or decreased in the last 12 months? So your response options here are that they've stayed the same, or there's been an increase of 5% or 10%, or a decrease of 5% or 10%. I will give that a couple of seconds and allow Toby to share with us the answers here. I would say, as an aside, in the consumer survey data we've ran globally over the last 6 years on this question, the results are very counterintuitive in many markets and highly variable across those different markets, insofar as where incumbent banks are feeling competitive pressure and where, in fact, incumbent banks feel very confident and have managed to close the experience gaps between those new entrants. Toby, if I could pass it to you for.
Yeah, absolutely. Really interesting so far. And just give it a couple of seconds because as the results are coming in, we are starting to see a theme emerge, which is that the threat overall has increased, tends to be the general consensus by 10% and 5%. But then actually there is a very small group that actually believe the threat has decreased, which is pretty interesting as well. But overall, it's driving towards the increase.
Thanks, Toby. Yeah, that gives us a lot of talking points for the next slide. So if we adjust directly that, so you're looking at the graphic on the bottom. So globally, 61% of retail banks believe the threat from fintechs and other challenges is increasing. But you'll see that if we pull out Middle East Africa region, there's actually been a decline in that perceived threat by 10%. Now, if we ask a broader question, you're looking at the circular graphic on the top here, that 56% of retail banks think that it's become more challenging to win and retain customers in the last 12 months. Globally, that's up 3% from last year. But very interestingly, if we look at Middle East and Africa, there's actually a sharp increase, right, in the acuteness of those challenges, suggesting a real intensification of competitive pressures, but seemingly not one that is emanating from new entrants and new digital banks. Now, if we dig in a little more to what we think might be happening here, so this slide shows market shares for some key countries across the region. The overall story here is that the largest banks in UAE and Saudi have seen a 10 percentage point increase in their market shares across the last 10 years. So Emirates MDB is approaching 30% market share of all UAE deposits. First Abu Dhabi Bank became the third largest in 2024. And I've just got on the screen here, both Islamic Bank and Abu Dhabi Islamic Bank lost market share in 2020. And in Saudi Arabia, some of the key changes have been Arab National Bank entering the top 5 retail deposit holders with 7%. And if we look at what might be driving this, so you're seeing on this slide NPS scores. Saudi's bank's NPS results saw the biggest improvements since 2024. I think as incumbents began to innovate in line with the government's Vision 230 digitalization roadmap, and with challenges such as SDC Bank. We also saw big NPS improvements in Nigeria and the UAE. The biggest improvements there, Access Bank, First Bank of Nigeria, and then Masrek Neo Citibank from UAE. Meanwhile, customers from the UAE continue to signal the highest likelihood of turning to their primary bank to help them achieve their financial goals. This is a key relationship point for us, right? Highly indicative of massive potential for cross-selling, because the bank is trusted to help with their needs in those most high-value, high-risk banking opportunities. But actually, the data we have here, currently a quarter of savers and 42% of investors do not own their products with their main bank. That's for UAE and for Saudi. So it's suggesting that there's an untapped opportunity for cross-selling and further relationship building. In terms of how new digital banks are seen in the region, so I'm delighted to share here some executive survey data conducted by Celent in 2025. Just so you know the sample size and breakdown. So this was 50 respondents, 30 in Saudi Arabia, 30 in UAE, and the rest pretty evenly split across Oman, Kuwait, Bahrain, and Qatar. So the first point here is that 50% of respondents across the region strongly agree or somewhat agree that the regulatory environment is friendly to new digital banks. On the right here, we just try to flesh out what we see of some of the key regional differences in that regard. The next question Celent asked was, to what extent are these new players perceived as a threat? Now, notice the wording of the question here is either in this region or globally, but nonetheless, the highest percentage that indicate they strongly agree is that digital banks are an opportunity to modernize. Now, either that's launching an incumbent bank, new entrant themselves, or as a de facto innovation departments, allowing incumbents to follow a fast follower gap reduction strategy, copying those best new features. Though, that said, as we see at the box highlighted in red here, there's still 10% that strongly agree that these players will be formidable competitors, and 40% that somewhat agree. And as you can see on the slide there, that 40% somewhat is the highest, the largest column response option size of the new option. So digital banks are absolutely simultaneously seen as an opportunity and threat. And in the response on the right here, you're seeing just how many respondents have actually already launched a new digital bank or have one on the roadmap. So you've only got here 8 out of the 50 that have do not have one in market at the moment, or any plans near term. Celent then surveyed these respondents on what are seen as the main metrics for success of new challenges that will either soon be launched or already launched. I think the most striking thing on this slide is how low break-even profitability is as one of their response options. Basically, very close to being last. That is entirely consistent with the hard-won experience, I think, of digital banks the world over. This stuff takes time. emancipated from the legacy of the mothership, new entrants can support retention of younger customers that want a more cutting-edge digital experience. They can compete with other new players. And on cloud-native cores, there's obviously scope to explore various new business models, particularly embedded finance, which we'll come to next. But in terms of where the most promising ROI opportunities may lie direct to consumer, I wanted to make one final observation, drawing on slightly older consumer survey data. We didn't run exactly the same survey question in subsequent years, but I still think this information is important context, and that likely the sentiment wouldn't have changed much in the last 2 years. And sorry, lastly on this slide, on the right here, of course, you're looking at high confidence in achieving those desired goals of acquisition and customer numbers. So these are the two additional contextual points I wanted to share. So on this slide, you're looking at openness to non-traditional providers. And bear in mind, this is for the mortgage, so the most high value, high risk product. No surprise on the left that the young consumers are more open than older consumers. That has always been thus. But on the right here, if we break these responses out by region, you see Middle East and Africa is standout region for openness to non-traditional providers. So only 45% prefer traditional players. And then the openness to non-traditional providers is spread pretty evenly across a variety of new digital entrants. But you see digital-only banks there at 14 as joint first place as the highest alternative provider. Now, if we stick with that same region, this slide shows willingness to pay for premium features. Now, instead, the generational split is on the right here. No surprise again that younger customers are far more willing to pay for those extra features. But if you look at on the left, the regional split, Middle East and Africa, significantly more likely, an extreme outlier here. So 85% are willing to pay for premium features. In the digital bank context, right, we take this openness to non-traditional providers and that willingness to pay for premium features as a tantalizing prospect, particularly in the ROI context, implying that more revenue can be generated from fees while gradually building out income from net interest margin, which we know now is the cornerstone of digital bank profitability in most markets. I think, we'd also add here that obviously the most successful digital banks that we have profiled around the world are all almost exclusively about the economics of financial inclusion, whether that's WeBank and MyBank in China, Nubank in Latin America, Chime in US, Time in South Africa. These case studies are well known. And I'd add one last proof point on that. Also, if we look at those investors with the most proven history of picking winners, so SoftBank and Tencent's venture arms, they continue to push money into multiple markets worldwide that exhibit a high level of mobile penetration but a low bank population because of the perceived size of the prize. And this consumer survey data suggests that actually the Middle East Africa region may be a much sweeter opportunity for that than some of the other markets that already have those big financial inclusion digital banks. One more reference here to the digital bank report. So if you can scan the QR code here, can take you to some sample copies of that content, but we'll also be sharing some more after the session. Sticking with digital acquisition and retention as a topic, I now want to move to embedded finance. So this slide is showing, this is from Celent's latest executive surveys, bank product level investment priorities coming into 2026. So you note here, buy now, pay later, so that's the most mature product incarnation, right, of embedded finance, is ranked as a first order priority by the highest number of respondents here at 14%, and digital account opening at the top there at 14%, which we'd argue is closely related to buy now, pay later anyway, insofar as they're both about retention and acquisition. The one is through non-proprietary bank channels. But if we break these response options out by region over here, so you can see that buy now, pay later is significantly lower. I mean, it's the lowest of the regional comparisons. Yet at the same time, bank as a service is in fact much higher, and it's a top priority for the region. Definitionally, these are very clearly related business models. Buy now, pay later is a consumer-facing product, or what, of embedded finance, whereas bank as a service is often the how of embedded finance. These product level priorities are entirely consistent with what we see in terms of consumer adoption trends. So the global buy now, pay later market has grown rapidly, particularly since 2021, as customers sought more flexible short-term financing and merchants used it to lift conversion rates, increase basket size. Over the next 5 years, we expect more of this growth to continue, but it will be more uneven, right? So mature markets will slow as regulation tightens. We've had consumer duty regulation in the UK being applied to buy now, pay later providers. So that's some of the most advanced, we would argue, in any market. But we expect in emerging markets for that the increase, the rate of growth to be the historical high levels due to low card penetration and strong e-commerce growth. And what's interesting, I guess, in that context, as you see on this slide, is remarkable buy now, pay later growth in Saudi Arabia. So 85% of consumers have used buy now, pay later. More interesting, I think, actually, than the volume of transactions, which is driven by the rapid expansion of e-commerce and mobile first populations and so on, is who is now on the other side of these transactions. So buy now, pay later is no longer confined to just younger customers or poorer customers. That characterization is now badly out of date in many markets, but particularly in Saudi Arabia, where in fact the largest portion of users are middle-aged, middle wealth brackets. Certainly, buy now, pay later does play an important financial inclusion role in many markets, especially we see that, I think, in LATAM, according to our survey data. But also among this use among the affluent underlines that while adoption trajectories necessarily vary based on local market dynamics, embedded distribution is how a lot of people will eventually want to consume all of their products because it's that much more convenient than alternative channels. Now, I don't want to overdo at that point. I think things like embedded mortgages can seem a bit far-fetched, but here's some survey data again from 2024 because the question set changed slightly, but again, it gives you an interesting sense of the sentiment. And bear, this is from two years ago nearly. It covers how many providers are exploring some sort of embedded mortgage proposition. And you see the high number here that are exploring it, but also the high number that already have some sort of proof of concept in place. Now, no one is suggesting that is a full mortgage application, but it's no doubt efforts to protect against disintermediation and expand reach by partnering, say, with a property search site and offering some sort of initial mortgage in principle agreement through that third-party channel. The US, I think, is an interesting future view on that. So Rocket Mortgages, the leading digital mortgage lender there, has acquired Redfin, a leading property search site. But I would say, again, the consumer data and the openness we've seen across the region for mortgages, again, implies perhaps this region is more ripe for that opportunity than other markets that seem to be more mature in the currently live proposition. However, we'd argue here that while the kind of direction of travel is clear in terms of consumer adoption, so more embedded consumption, we'd argue that the commercial and operational models around BaaS aren't quite as clear, and that's despite BaaS being the next big thing for quite some time now. I've got on this slide a crude map of the overall ecosystem, but I just wanted to stress some of the key lessons or risks that firms preparing a BaaS proposition have experienced around the world. I think the first one is that embedded distribution means you're taking on customers, making real-time decisions that impact your balance sheet exposure. The risk thresholds, fraud, credit risk, AML, and so on, having smooth orchestration layers that can bring together multiple vendors that deliver that into one unified decision engine that can act reliably and act in real time, log every decision for compliance purposes is critical. Many traditional bank models are too clunky or too sensitive for an embedded finance context, meaning that they will create too many false positives. So cutting off the slick US, which is central to the adoption of this. And we've seen a number of banks that want to enter this space, make acquisitions or partner with orchestration layers so their risk parameters can be carefully calibrated rather than working with existing providers that don't have that level of flexibility. And then the bank risks taking on customers that are too risky or don't meet their risk profiles. That risk factor is not just, I think, for the end consumer, but also is important for the bank partner. So every BaaS customer comes with its own risk profile, business model, customer base, transaction volumes, and so on. We've certainly seen, I think, in the US that the many regional banks that went after this opportunity, filling the squeeze from big universal banks with superior digital experience, didn't do enough due diligence on the BaaS partners. And then as the regulatory situation was clarified, they found that actually this opportunity is a lot more riskier than their initial thought. It seemed like a bit of a gimme that they could lend their bank license and not have to do much of the risk work. I think many firms in that market have been badly burned, and the regulatory pendulum is swinging back to make this far more favorable, actually, for those big banks that have the most experience doing that risk assessment. Of course, the qualifier we make for that is that it's only an opportunity for big banks if they're building it on cloud native technology. So we've seen the institutions that have made the biggest push have almost exclusively built their own multi-tenanted core. So NatWest did that, its first SME bank, Metal, and then its second tenant was Boxed, its BaaS proposition. Standard Chartered have done the same, BVA have done the same, and of course all those new cloud native core banking vendors, 10x, Fort Machine, that were offering BaaS were all doing it based on that accelerated setup time for new entrants in multiple markets. I know we're running against the clock here, but I wanted to finish with AI. Last, but very obviously not least, the first point for context is that there is obviously huge anticipation here, and that is a huge understatement. But implementing AI at scale, so bringing projects from pilot to production, there's a growing awareness now that that takes time and that it is expensive. There's a significant initial setup around model setup and training, all the infrastructure costs, GPU and hosting costs. Often banks need to enhance computing capabilities. So all of that taken together, this is just a crude kind of sketch of what that looks like. But based on the research interviews that we're doing, that likely puts ROI out at 3 years, which is much further than some firms initially hoped, and has dampened enthusiasm for this sort of scattergun approach, which I think we saw in the earlier days, particularly of generative AI, where the widest range of possible use cases were pursued. Even JP Morgan, right, the bank with the most outrageous technology budget on the planet, the very deepest pockets, has stressed in successive earning calls over the last 3 years this move towards a more pragmatic and disciplined approach, the need for contained, high impact use cases. That was from their CFO, Jeremy Barnum. But just to underline the awareness of how easy it is to overspend in the rush to find the killer use cases. But despite that, right, in the Celent survey last year on technology priorities coming into 2026, no surprise, the artificial intelligence was still ranked the #1 priority. A slight decrease actually from last year, maybe in response to some of those some of those ROI issues. But note also the #2 category, workflow automation, agentic AI, is very closely related to AI. When we break those responses out regionally, specifically for workflow automation and agentic AI, you see that's where, in fact, Middle East Africa comes up as the highest priority. So that seems to be where the focus is for 2026. Now, I would say on agentic AI, the last few months have been a little bit confusing on definition. We've had what we call quite a lot of agentic washing. So vendors claiming as agentic capabilities what we would argue better described as simple bots, which can be problematic, particularly for early adopters, because they can become frustrated by the lack of sophistication and effectiveness in early deployments. But at the other end of the scale, which can be equally problematic, is those purists that are adamant only the most advanced multi-agent systems can be considered agentic, and that creates frustration around the time and the cost to get set up and running. Right now, as an industry, we think that we're broadly between level 1 and 2 here. But of course, long term, the promise of multi-agent systems is that discrete pieces of capability can be more easily reused, repurposed, and redeployed than single agent systems, so that they're less like a micro service. And this has huge implications because it applies an end state where eventually all workflows and capabilities in a bank can be translated into these underlying agentic capabilities that can be reconfigured in multiple different ways. And that's right, an entirely different level of organizational agility and flexibility than you would get just by automating individual processes. And recall in the earlier slides on drivers of IT spend for the region, greater speed and agility was the highest priority. That's what banks were seeking. But I think what we're going to see in this space is the challenges between the tactical time to market priorities. So banks that need to do the next easiest thing to secure a quick win, get more ongoing support for the AI deployments, and then the more long-term strategic considerations around architectural consideration. So there are a number of things that have to be done differently to build for multi-agent systems long term. I think we can think of this as analogous to digitizing a paper process to redesigning the entire process in a digitally or AI native way. Alongside that, we've got all these very well-known risks with implementing agents. I'm not going to dwell on these, but they are certainly biggest in the FS context and biggest in the agentic context. And we could add to that for the Middle East Africa region under current geopolitical conditions, there's a heightened risk of these agents acting in unpredictable ways, given the velocity of change and unexpected outcomes we're seeing across a variety of different dimensions. Even in more markets less impacted by geopolitics, these risks are creating a real ambivalence in the marketplace around risk tolerance. I've got just a sample of quotes here. Admittedly, these are primarily from banks outside the region, but just to make the contrast here, right? So let's take Bank of America. That's got 20 million clients using Erica. I think it had a 98% containment rate, 2.4 billion interactions. So like a standout success for bot-driven interaction. And all of their tech leaders are adamant there'll be no use of generative AI and agentic AI near term because of the perceived risks and because of the value they focus on maintaining customer trust ahead of adopting the latest technology. Contrast that, meanwhile, with BVA, in 2024, rolled out an internal store for agents and quickly had 3,000 different agents that were posted, not just from innovation teams, but anyone in the bank could post an agent, and now they're being adopted in a wide variety of scenarios, internal and customer facing. So we just argue that they are night and day comparisons of a different approach and view on the risk. Now, our forecasting team put together this outlook for AI. We can share it with the regional breakdowns afterwards. I would suggest to my esteemed colleagues here that this is the easy thing to do. So banks have already spent billions on AI. They are likely to spend billions more. The difficult question is who is going to spend that in a way to generate the most ROI. Now, I break out some of where banks are placing their bets into different regional areas. So you're looking at here, what was the focus in 2024, and then the focus to 2025. And this is it for a wealth management sample. You see on the top left here on advisor efficiency, I suggest the limited change year on year suggests this is where providers are confident of driving efficiency gains. Advisors wear many different hats. The hope with AI is that each one can be made 20% or so more productive in their job, allow them to focus on more high-end or high-value interactions. And I think that's perfectly analogous to what we see for customer service reps in retail banking. However, I would draw your attention to where Middle East Africa region is an outlier, both on broadening the customer base to new customer groups. So big increase 224 to 225, and also again on the role that AI can play in managing investment priorities. So 75 to 87%. I would summarize these results by saying regionally that in many markets, the expectation is that AI will make banks better at the existing things that they do. But across the Middle East and Africa, these results imply that AI will play a role in more disruptive business models, given reaching those new customer groups and playing more of a central role in investment management. That's already consistent with what we see on bot interactions. So for context here, in our consumer surveys for many, many years, bots are the least preferred channel for all consumers, all age groups, wealth brackets, and markets. Yet you see here for Middle East and Africa, even for wealth management interactions, the chatbot use is at its highest, again implying that there are the biggest opportunities for AI to further enhance those interactions. So there's reason here to think that the adoption of AI will play out differently across the region. Now, across all markets, when we think about governance and risk controls, the preferred method is to have a human in the loop of those interactions. It will be interesting to see if there is a higher risk tolerance in the region, given what we suggested on the survey data. Also, what the organizational models will be. Initially, most banks have preferred a centralized approach, which allows them to have more control and oversight, to share common tools across deployments, to measure business case and results. But in the most advanced cases, we move towards hub and spoke to eventually more decentralized. So it allows autonomous business units to act more freely, to calibrate their offerings to local market conditions and product types, to use small language models instead of large language models, and so on. And it'll be interesting to see again here any differences that materialize in approach across those regions. I want to pass back now to Toby to take us through this final poll question.
Amazing. Thank you, Stephen. That was truly insightful. There's a number of questions that have popped up in the chat. And before we get there, just like to hand back over to the audience, as you said, for the final poll of today's session. The question is as follows: which of the following would be most valuable to support your priorities over the next 12 to 36 months? Is it more looking at benchmarking your performance against your regional peers, deeper insight into consumer behavior and digital engagement, access to forward-looking market and technology trends, or improving visibility of more consistent, reliable market data, or finally, frequent, consistent access to analysts for ongoing support? The poll results was a clear 1 and 2. Access to forward-looking market technology trends and deeper insights into consumer behavior and digital engagement were the 2 options that really stood out, followed by improving visibility with more consistent, reliable market data, which is, again, a theme that we often see. There's one that says, it's interesting to see banks as a service as such a priority in MENA. Can you speak a bit more on some of the regulatory headwinds faced in the US and Europe and how that might inform things going forward across the MENA region?
That's been a big issue. I mean, I think for market context here, the bank as a service was very much seen as the next big opportunities. So 6-7 years ago, we had some unicorns in that area, and then I think those regulatory headwinds really challenged that business model. I think there were slightly different dynamics to the US versus Europe. So I think we saw in Europe that a lot of VC backed firms partnering with other VC backed firms that maybe had acquired for a new bank license or working on an e-money license, and that VC mindset created a sort of growth at all costs approach, but some of the AML and KYC issues were not properly addressed, particularly as that expansion happened quickly in multiple markets, and that explained Rails are one of the forerunners in that area, eventually filing for bankruptcy. The contrast, I think, in the US was that the Durbin Amendment meant that many smaller players could come in and see good financials from offering basic services, and we saw a number of different partners coming together to offer bank as a service. So you might have one regulated regional bank providing the bank license, but a number of front-end partners taking in the funds. And the issue that we saw with Synapse that reverberated completely through the fintech ecosystem, that there was a lack of reconciliations. And so deposits were being taken in that couldn't be accounted for across the various different custodian banks. And when the regulator tried to get their arm around exactly what was going on, there wasn't an obvious regulatory recourse. There wasn't one specific institution that could be held accountable. It wasn't easy to see where all the funds had got to. And I think a lot of firms that were involved in that were burned. I think the rest of the world has looked closely and said, actually, we need to have far tighter regulatory oversight and risk management when we've got multiple providers offering a bank service. So I think that is making it far more of a big bank opportunity, as long as they've got modern technology, as long as they're making partnerships, than it is for smaller banks that are having issues from a risk management perspective.
Amazing. Thank you. And there's a follow-up question on that as well. So is BNPL is a low priority in the region, but BaaS is a top priority. What's driving that gap? And what does it tell us about how banks here want to play with embedded finance?
Yeah, that's an interesting question. I mean, look, I obviously buy now, pay later from an interest rate perspective across the region may have some implications. There are some risk considerations, as I've spoken to, from the credit risk of the end consumers, from the risk of bank partners that may be taken on. If you've got a number of banks launching new digital banks across the region that have got the technology that's primed and set up to offer these sorts of services at a low marginal cost, that can be the easier first move into the market. I'm struck by, of all the new digital banks that we speak to, the first question everyone asks, having built a new cloud native core banking platform, how do we stand up a bank as a service proposition? Because it's such low hanging fruit in that context. So I think that's probably partial explanation for what we're seeing there.
Great, thank you. It's been an amazing session. We thoroughly enjoyed all of the questions that's come our way. We will be sure to get back to as many of these questions as possible. Again, the QR code is used as an opportunity for you to learn more about global data and how we might be able to support you achieve some of your operational and organizational goals there. But again, look, thank you so much for your time. We thoroughly enjoyed the conversation, and we look forward to being in touch moving forward. Thank you.
Thanks, everyone.